Turn on the TV, and on any given weekend, including last weekend, you're likely to see one, if not all, of the John Wick trilogy movies. Throughout the series, John Wick is described as a ghostly, almost mythical figure. He's a dark figure, dressed only in black, lurking behind shadowy corners. He's the assassin the Russian mob sends to kill assassins. He appears out of nowhere to seek revenge against others for their wrongdoings. According to his former Russian mob boss, John is a man of focus. He's a man of commitment and sure will. He's been given the nickname Baba Yaga, meaning the Boogeyman. For those of you unfamiliar with the John Wick movie trilogy, played by Keanu Reeves, there's a link in the description below. Be warned, there's some strong language in it. There's a scene here when actor Michael Nyqvist plays Viggo, John Wick's former boss. He introduces John Wick. It's brilliantly written, eloquently delivered, and perfectly timed, with clips of John Wick set to a tone of ghostly, unstoppable. He's a presence. He's nicknamed Baba Yaga, short for the Boogeyman. I'm Chris Parrish, Chief Investment Officer at Oak Harvest Financial Group, and this is our investment team's midweek release, where we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise for your money? This week's take on the story of the Federal Reserve balance sheet reduction, and if the reduction to come in September is Baba Yaga or the Boogeyman for your money, out to silently hunt and assassinate your investments. The Fed has used two tools to affect monetary policy since the great financial crisis in 2008 and 2009. Those tools, interest rates and its balance sheet. More and more bearish slanted stories have hit the news wires lately, centered around the reduction in the Fed's balance sheet, also referred to as quantitative tightening or QT. Recall that the Fed initially announced a combined $47.5 billion per month, $30 billion in Treasuries, and $17.5 billion in mortgage-backed securities on its balance sheet runoff for the second quarter of this year. They then said they would double that to $95 billion per month starting this September. While the exact impact on the financial market conditions is unknown, many strategists have recently doubled down on the bearish second half market calls, calling for 3,000 on the S&P 500. They cite the Fed's balance sheet runoff and quantitative tightening as the big reason for this, reasoning that QT will remove more liquidity and stability from the markets later in the year. Future QT is the dark shadow lingering over the markets. It's their unknown. QT or quantitative tightening is their Boogeyman, their Baba Yaga, their shadowy, unseen figure lurking in the dark. We've shared a graph charting the Fed's balance sheet and the S&P 500 a few times over the last 3 years. Here it is again. It's available to the public for free, along with all sorts of other data on the St. Louis Fed's website. One can clearly see from the chart that yes, historically speaking, the S&P 500 has had a harder time moving quickly higher when the Fed's balance sheet is stable or declining. Check out the time period from the second half of 2014 through late 2016. The Fed's balance sheet was flat to marginally down, and the S&P 500 struggled for about 2.5 years. However, in 2017, the Fed's balance sheet was flattish, and the S&P 500 still broke out and sustained new all-time highs all year. In 2018, post the Trump tax cuts, the Fed reduced its balance sheet. However, the S&P 500 still made new, albeit unsustained, all-time highs in the summer, before almost a 20% move lower into Christmas Eve in 2018. Historically speaking, is the upcoming round of quantitative tightening later in the year destined to be bad for your portfolio? Is it destined to be your Baba Yaga, your Boogeyman, a silent assassin? Not necessarily, but it is news for your portfolio. While it's likely to be a headwind, there's no certainty that'll bring new stock market lows later in the year. At Oak Harvest, we think our clients are best served by us helping them plan for their future needs instead of focusing on the past. The future is always uncertain, and that's why our advisors and retirement planning teams plan for your retirement needs first and your greed second. Give us a call here to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. I'm Chris Paris, and from the whole team here at Oak Harvest, have a blessed week.